Economic News Roundup. The U.S. Treasury market, a linchpin of the global financial system, has experienced significant turbulence in recent weeks, leading to growing uncertainty about the future trajectory of interest rates and its impact on U.S. stocks. Repeated selling of Treasury bonds since September has propelled yields on the 10-year and 30-year Treasuries to levels not seen since the lead-up to the 2008 financial crisis. This volatility stemmed from concerns about a more hawkish stance from the Federal Reserve, the U.S. fiscal deficit, and ongoing geopolitical tensions. A Treasury bond auction and persistently high inflation further exacerbated the situation, resulting in a sharp decline in U.S. stocks.
Join our YouTube community. Be part of our YouTube journey. Subscribe now. Get exclusive content, stay updated, and join a community of like-minded enthusiasts. Please subscribe for $1,000 early bird draw.
While investors are now grappling with the question of what will trigger a reversal in interest rates and bond yields, some analysts suggest that a shift towards disinflation may not be sufficient to prompt the Federal Reserve to abandon its higher-for-longer interest rate narrative. They propose that a slowdown in consumer spending may be necessary to influence the Fed's approach. Although the central bank has not hinted at changing its stance, a possible weakening of consumer spending, as consumer product and service companies provide guidance for the fourth quarter and consumers engage in holiday shopping, could potentially prompt a shift in the Fed's outlook. Despite these dynamics, market seasonality, historical patterns, and evolving sentiment may influence the market's direction as we approach the end of the year. The Federal Reserve's ongoing battle against inflation has led to higher borrowing costs in the subprime auto loan market, particularly affecting lower-income households. Subprime borrowers are now paying annual percentage rates, APRs, ranging from 17% to 22% on new auto loans, a significant increase from last year's average APR of around 14%. These higher costs could strain households, increasing the risk of late payments, defaults, and car repossessions. Nevertheless, the subprime auto sector has witnessed nearly $30 billion in new bond deals this year, indicating strong investor interest and confidence, despite the rising rates. While some experts believe a reckoning may be on the horizon if rates remain elevated, predicting when the turmoil might strike has proven challenging. The economy has displayed resilience, even with the Fed raising its policy rate to 5.25% to 5.5%, and the central bank has signaled the need to keep rates high to combat inflation. Longer duration bond yields have risen but remain below 5%. While the Fed is expected to maintain rates at its next meeting in November, concerns persist about the potential challenges posed by prolonged high rates. The impact of these higher rates on lower-wage workers, who are historically more vulnerable to economic downturns, serves as a canary in the coal mine for the broader financial markets. However, investors in subprime auto bonds have yet to demand significantly higher spreads to compensate for the potential rise in defaults among these borrowers. Despite the increased yields, investors have retained confidence in subprime auto bonds, as indicated by strong demand and minimal spread adjustments in recent bond deals. The rate of subprime auto loans at least 60 days past due has risen to about 5%, up from historic lows around 2.5% 2 years ago, but investor confidence remains intact. The Russell 2000, a small-cap stock index, recently registered a death cross, marking the first such occurrence this year, signaling downward momentum in the market. Small-cap stocks have faced a challenging year, underperforming as rising crude oil prices led investors to seek safety in Treasury bonds and gold. However, historical data suggests that small-cap stocks have typically rebounded after death crosses, with gains of 6.7% 6 months later and 15% 1 year later. This development comes at a critical time for small caps, which have struggled due to rising interest rates and borrowing costs, and they recently hit an all-time low relative to the Nasdaq 100, underscoring their challenging conditions. Global finance officials are growing increasingly concerned as the era of higher-for-longer interest rates takes hold, signaled by rising long-term bond yields, indicating the end of cheap borrowing. During the recent International Monetary Fund meetings, These officials voiced worries about the potential repercussions of tightening monetary policies and the risk of inflicting a shock on a world economy already grappling with geopolitical tensions, such as the ongoing conflict in the Middle East. High debt levels and the environment of sustained higher interest rates have raised concerns, with the recent occurrences of regional bank collapses and ongoing real estate uncertainties serving as examples of the challenges finance leaders have faced. The group of 20 finance chiefs concurred with these views, highlighting various risks in their communique, including geo-economic tensions, extreme weather events, natural disasters, and the tightening of global financial conditions, all of which could worsen debt vulnerabilities. While some reassurance about the resilience of the financial system's core was offered, concerns persist about the multifaceted threats to stability posed by this new era of higher interest rates, especially in the context of ongoing global challenges. The US dollar retained its strength, putting pressure on a basket of currencies, following stronger than expected US consumer inflation data. This data has revived prospects that the Federal Reserve may need to maintain higher interest rates for an extended period. While steady moderation in underlying inflation pressures supports expectations that the Fed won't raise rates next month, the data does raise the likelihood of rates remaining elevated. The dollar index, which measures the U.S. currency against major peers, held steady at 106.49 in the Asian morning. The Japanese yen, sensitive to the 150 line, slid closer to this level, which could trigger action from Japanese authorities as it did last year. Market attention also turns to upcoming economic data from China, including trade data, consumer inflation, and producer prices for September, which could provide insight into the country's fiscal stimulus plans. Investors are looking for signs that China's data supports further stimulus measures, with the offshore Chinese yuan and other regional currencies closely watched. The euro ticked up, while the Australian dollar, often seen as a proxy for China's growth, held its position, and the kiwi fell slightly. Sterling was trading at $1.21885. Microsoft's acquisition of gaming giant Activision Blizzard for $69 billion will have a profound impact on the tech giant's gaming division and its overall competitive position. With this deal, Microsoft significantly bolsters its gaming portfolio, gaining control of popular franchises like Call of Duty, World of Warcraft, and Overwatch. This move is expected to boost the company's presence in the gaming industry, making it a more formidable competitor against industry leaders like Sony and Nintendo. Additionally, it enhances Microsoft's cloud gaming service, Xbox Cloud Gaming, by offering a broader range of gaming content, potentially attracting more subscribers and strengthening its position in the fast-growing cloud gaming market. Moreover, this acquisition allows Microsoft to exercise more control over content creation and distribution. By owning Activision Blizzard's intellectual properties, Microsoft can develop exclusive gaming titles for its platforms, further enticing gamers into its ecosystem. This not only drives hardware sales but also supports its subscription services like Xbox Game Pass, contributing to Microsoft's overall revenue growth. However, the deal's success depends on Microsoft's ability to navigate potential regulatory challenges and effectively manage the newly acquired gaming assets.
Buying good stocks can be a good investment for several reasons. 1. Potential for capital appreciation. 2. Dividend income. 3. Diversification. 4. Liquidity. 5. Ownership and voting rights. 6. Historical returns. 7. Inflation hedge. 8. Professional management. 9. Tax benefits. 10. Accessibility. It's important to note that while investing in good stocks can offer significant advantages, it also carries risks. Stock prices can be volatile, and there is no guarantee of positive returns. To make informed investment decisions, it's essential to conduct thorough research, consider your financial goals and risk tolerance, and, if necessary, seek advice from financial professionals.